Welcome. Thank you so much for attending our online class today. I think you're going to get a lot out of it. We're going to talk about FHA, down payment assistance, how it can help your buyers. I'm super excited to share with you all of the assistance programs that are available. People don't even know about most of them. A lot of people need FHA and need down payment assistance in order to purchase a home. And they will never forget that you were able to help them with that. So I'm going to go through a lot. I'm going to go into a lot of detail. You're not expected to remember everything by any means, and things change constantly. So please check back for regular updates. We've had loan amount changes, mortgage insurance changes, underwriting changes recently. This should contain all of the latest information, but you're free to check back regularly or to contact us for more information if needed. For today's agenda, we're going to go through FHA loans, recent policy changes, like I mentioned just a second ago, qualifying for FHA financing. So it's really easy actually, but we'll go through some of the details there that the underwriters are going to be looking for. The down payment requirements, along with down payment assistance programs that can be utilized to help fulfill that down payment. Mortgage insurance, how much is it per month? How much is it up front? What's it going to cost you and how long is it going to stay on your loan? We'll go through those details. Property compliance, that's a huge FHA, VA, government loan concern. Everyone asks about property compliance. So we'll go into that as well. Closing costs, how much are those? General information about down payment assistance, all of the programs. We'll go through those in a lot of detail. I'll give you guys a break right before that because there's just so much information. We'll talk about CHFA, which in and of itself is an assistance program. We'll talk about city and county programs that exist. There's a ton of them. Almost every city and county have their own. I'll show you where to find those online as well. And then we're also going to talk about the HUD properties, Good Neighbor Next Door program, and another grant program called NHF, which I think all of you are going to find is very useful for a lot of your borrowers. And lastly, we're going to talk about writing the purchase contract. When your buyer's using down payment assistance, there's a couple little things that you may want to mention in the contract. Alert everybody to where the funds are coming from, how they're going to be obtained. You just don't want to have any confusion, and we want to make sure that all parties are aware that down payment assistance is being used for the purchase. And sometimes the lender letter may even include that as well. So what are some recent FHA policy changes? Mortgage insurance is really one of the biggest. So as of January of last year, so a year ago now, the upfront mortgage insurance is 1.75% of the loan amount. That's fairly hefty. However, they're trying to raise the amount that's financed because most people just can't come up with that and don't want it included in their monthly payment. Most buyers, especially buyers that are going to be using FHA, any assistance program, they're going to be very payment sensitive, and we're going to be watching the debt to income carefully to make sure that they qualify. So the more that we finance at $5 per month per thousand is cheaper than the monthly being added. The monthly is now 0.85%. Which has come down, and it's a lot more affordable than it was before. It's much more competitive with your conventional loan scenarios now. And so you'll take the 0.85 times the loan amount, divide that by 12 for the monthly amount that would be owed. And we're gonna go through that in just a second on another slide so that you'll see exactly kind of how that would break down. You kind of have a figure in your mind to use with your buyers. New borrowers are required to have a minimum credit score of a 580 to qualify for the maximum financing. So 96.5%, that's 3.5% down. To be honest with you, a lot of buyers with a 580 do have some credit issues, so that might be something that you want to help them with first or have somebody help them with first to get their credit scores up. They'll get better interest rates, much more competitive, and they'll qualify for a lot more of the assistance programs, which all have their own credit score requirements as well. And the new borrowers with less than a 580 credit score are going to be held to a 90% loan to value. So that's something to remember. They would need at least 10% down. That's somewhere where we'd probably want to get their credit score up first so that they don't have to come up with 10%. Most people don't have that kind of money, or they wouldn't be looking at a program like this. So we want to be really careful about that too. A few more changes to talk about. FHA can now obtain indemnifications on to the underwriter or to the lender, the bank that's going to be funding the loan. So If the loan is underwritten and the decision is made to approve the loan and there was a material defect in the underwriting, that can go back to the lender. So please keep that in mind. I mean, that's why you've seen a lot of tightening of underwriting. It's why you see a lot of overlays. So a lot of banks, you're going to hear the word, well, you know, FHA goes to a 580, but we have overlays and we won't do a loan under a 600. That is a bank overlay. That is an individual decision based on the quality of file that they want to see coming through. So they're not willing to approve a loan under a certain credit score or over a certain debt to income ratio, although FHA says it's okay. And that's because they don't want things to come back on them. They don't want to lose their ability to underwrite and approve FHA loans. It's very important that you know that. Every lender is going to be a little bit different on what they're going to require, but it is important for you and your buyers to realize that as well. They're going to get a few different answers and it can be confusing, especially based on what they see online. When you look online, you're going to see FHA rules and regs. You may not get exactly what each bank is going to require. So keep that in mind. They're just trying to protect themselves so they can continue to offer these loans to your buyers. As of January 1st, the 90-day rule is back. January 1st of 2015, just making that differentiation there because we just passed into the new year. So you're going to want to make sure that you realize that if your buyer is looking at a property that has been purchased within the most recent 90 days, regardless of for how much and how much they're trying to sell it for, you are going to be held to 90 days. Your buyer cannot qualify within 90 days of the current owner having taken title. It happens all the time, and a lot of times it requires a new contract to be written after the 90 days has passed. But to fulfill FHA's requirements, regardless of the difference in purchase price, 90 days has to have passed before a new buyer using an FHA loan can purchase from someone who took title within the last 90 days. FHA down payment. Let's go through that a little bit because it changed fairly recently within the last few years, and I still get a lot of people asking, I thought FHA was 3% down. FHA requires 3.5% down, not much more than it used to, and it's been very possible for most people to come up with that also using these down payment assistance programs. So 3.5%, that's $7,000 on a $200,000 purchase price, and they can get loans from their 401k, other retirement account. We'll go through those specifics here in just a minute. Buyer can use their own funds, so they don't have to have them seasoned as long as we see where they came from. So they don't have to have been in their account for 60 days or more. We could use tax return money. That happens a lot. We're going into tax season. A lot of people are going to be getting money on their taxes, and they want to use that for down payment. That is considered seasoned funds. Loans from a retirement account, 401k, para, if allowed from your para account, that's another great source. Those are seasoned funds. They're your own money. It's been there. We just document where it's coming from. Buyers can use a gift. Tons of buyers need a gift from their family members. They're only allowed to obtain those gifts from family members, and they do have to be well documented. This is one of those things that the buyer is going to complain about as well as the gift donor. Please keep in mind that when you get a gift from a family member, we have to document that the gift came to you, that the gift was deposited into your account, and that the gift came out of your grandmother's account or whoever it was given to you from. And a lot of times those people, the donors, do not like to give their personal information. They don't understand why they should have to give their bank statement to show that they gave a gift. They wanted to give a gift. They sign a letter that says we gave a gift and we want it to be utilized for the purchase of this home for our grandson or grandchild, whatever. And they don't want to have to prove that it came from their bank account and provide their bank statement with the account number and name on it. It is required. It is an FHA requirement. So please keep that in mind when the buyer calls and says, oh my goodness, the lender's asking me for a bank statement from my grandma and she lives in Alabama and she doesn't know how to scan. That's going to be something that we're going to need. So please know that so that you can support the lender in that respect and say, yes, unfortunately it's required. How can we make this easier for you? That's kind of all of our main goals is let's make this as easy as we can for the borrower, the least amount of stress possible so that we all get through this and everybody's happy in the end. And then if none of those sources are available and the buyer doesn't have the money of their own, they can use down payment assistance. And that's what we're here to talk about today. Like I said, there are a multitude of different programs that you can use. There's tons, city, county, statewide, and a lot of just nonprofits that offer some grants. Some of them are out of state and they offer grants here in Colorado. And there's been a lot of changes with those. So we'll cover all of those in great detail here in just a few minutes. So how hard is it for your buyers to qualify for an FHA mortgage? Again, we've mentioned the credit score. A 580 credit score, not too hard. And if there is credit help needed, we can help with that before closing. There's definitely a lot of sources available to buyers to help with credit in order to raise those scores so that they're at least the 580. And if we could get them higher than that, that would be fantastic. No asset requirements yet. There are supposed to be, coming down the pipe, requirements per FHA of 1 month PITI, 1 month principal, interest, taxes, and insurance in an account somewhere in their name. It could be a bank account, a retirement account, somewhere an asset. But right now, it really depends on the quality of the file. You know, you can get an approval with very little money in the bank, but fantastic credit. Or you could get an approval with a lot of money in the bank and mediocre credit. So it's the whole package. The systems that underwrite these files in the computer system, they want to see low risk. So they're going to be looking at debt to income, assets, and credit, job history as well. Those are all different pieces. So some people have 2 or 3 of those, but maybe not all of them, and that's okay. Most lenders know how to use these systems really well, and we can figure out how to make it work for your buyers. 3.5% for down payment, we just talked about that, or down payment assistance as well. Debt to income ratio, so FHA will allow you to go as high as 55%. Actually, I think you could even go over 55%, depending again on the quality and the risk level of the file. So it needs to be very strong once you get those debt to incomes over about a 45%. And on the debt to income ratio, so for those of you who may not be familiar with what a debt to income ratio is, it's often referred to as a DTI. It is the amount of total debt, including anything that would appear on a person's credit report as a minimum payment, car payments, credit cards, student loans, versus total gross monthly income before taxes. So when we calculate that, most lenders are going to want to see a buyer under a 45%. We can go as high as a 55%, depending on the strength of the file. But a 45% is a really solid number that fits most loans very well, depending on assets, credit score, and things. A 45% is approvable. So something to keep in mind for your buyers for sure. Another thing I'll mention here, just because we talked about student loans for a second, a student loan debt, if deferred, did not used to count in the buyer's ratios to qualify for a loan. Keeping in mind, those could be $50,000 or $100,000 in loans, which could the payment of that would be $500 a month. That really affects a buyer's ability to qualify. And in some cases, if the buyer is still enrolled in classes, that payment's not due. As a matter of fact, they don't even know what that payment will be when it comes due. However, in September, that changed with FHA. We now have to count the student loan against the borrower's debts. So that has affected some things as far as qualifying goes. It's just a good thing to keep in mind. These are good little things for you to remember so that when you're talking to a buyer and they say, oh, I have student loan debt, however, it's not going to be due for 3 more years because I'll still be in school. Now you know in the back of your head, oh, you know what? You might want to talk to a lender because I think that it does count as your total debt, and it greatly affects somebody's ability to qualify for a loan. So do keep that in mind as it applies to debt to income or the DTI, whichever you'd like to refer to it as. So how does FHA mortgage insurance work? A few minutes ago, I mentioned to you that I was going to go through a breakdown with you just to give you a basic amount. So again, when you're talking to buyers, you can say mortgage insurance on an FHA loan is roughly $137 a month or something, and you have that figure in your mind so that they've got something to work with, and when you're calculating a payment for them, you can kind of add that in. So the upfront mortgage insurance is the 1.75%. That's calculated off of a base loan amount. So the base loan amount would be a purchase price of $200,000, let's say, for example. Subtract off your down payment of $7,000 or 3.5% of the $200,000. So that leaves you with a base loan amount of $193,000. So that $193,000 is kind of where we work all of the numbers. Every lender is going to work off of those same figures on an FHA loan. So you go to the $193,000 and you're going to multiply that times the 1.75%. That's the base loan amount times the mortgage insurance premium. And that equals $3,377.50. That amount gets financed. That's included in their loan amount. It's going to increase their monthly payment, depending on interest rates, which depend on the loan program, of about $5 per thousand per month. Another really good figure for you to use when you're calculating things kind of in your head. A person goes up or down in purchase price or loan amount by $5,000 or $10,000. Increase that payment or decrease that payment by about $5 per thousand per month. That'll help you out. I use that calculation a lot. And then your total loan amount, once you add the $3,377.50 to the $193, leaves you with a total loan amount of $196,377.50. And that's what your payment's calculated off of. That's what the buyer's payment's calculated off of. So that's the total loan amount. That's basically the amount that the lender will be working with the whole time. Now, the monthly mortgage insurance is a little different. We'll use the same figures to keep it simple. So a $200,000 purchase price, you get to the base loan amount of the $193. The mortgage insurance is 0.85% of the $193, and then you divide that by 12 to get your monthly amount. So when we do that math, the 0.85% times the $193 gives you $1,640.50. Divide that by 12, and now you're at $136.71 per month. So, that's just a really good figure for you to know so that when you're talking to buyers, you can say, oh, the mortgage insurance will be about this much per month. It gives people a good idea, has a better understanding of how much their payment would be with taxes, insurance, mortgage insurance, all of the little details, HOA, if there's one on the property. And so that gets you your total monthly mortgage insurance. How long is the FHA mortgage insurance required? That is a question that's asked all the time because it just changed. So the FHA mortgage insurance is required for the life of the loan. It's never going to go away. Borrower's going to have it on there forever. Keep in mind, most people don't keep their loan for more than 5 to 7 years. So you've got to remember that because everybody gets very caught up in, I'm going to pay mortgage insurance for 30 years. Well, most people either sell or refinance within the first 5 to 7 years. So realistically, no, you won't. And FHA loans usually have a lower interest rate unless sometimes when we add these down payment assistance programs, it goes up a little bit. But, with a lower rate, the mortgage insurance is very competitively priced now. It's not a terrible thing to have it for the life of the loan. It shouldn't be as intimidating as it sounds. Couple things to remember. Prior to the recent mortgage insurance change, on a 15-year fixed FHA loan with greater than 10% down, there was no monthly mortgage insurance. Fantastic. It was this little niche thing that very few people knew about, and we got to do a lot of loans like that for people that were shopping for a 15-year mortgage because the rates on FHA are so great. They've done away with that, but it is lower on the 15 years. So if you're putting down greater than 10% on an FHA 15-year fixed, your mortgage insurance monthly is 0.45% versus 0.85%. So it's almost half. So that's great. And then if you're putting down less than 10%, so basically if your loan to value is over 90%, but under 96.5%, which would be FHA's minimum. So you're putting down in excess of 3.5%. Your mortgage insurance on a 15-year fixed FHA is 0.70% versus 0.85, and it falls off after 11 years. So it's not for the life of the loan. Just some little things to remember. Again, this is a lot of detail. I don't anticipate that you're going to remember all of this, but just little notes to keep just to kind of set you aside from the competition and just show people that you know about loans and know some of the details. So at this point, I think it would be really good. You might want to get up, shake around a little bit, answer a few quiz questions if you don't mind. I need to make sure that you're all still there. And then we'll come back in just a few minutes.